Hey folks, Will Allen with Sentara Capital here, and we film our videos on Tuesday for release on Thursday, and sometimes what happens is a big story breaks in the meantime, and that is what took place yesterday. The Federal Reserve cut interest rates, a move that was widely expected, but they signaled fewer cuts ahead in 2025. That triggered an over 1,100 point sell-off in the Dow Jones Industrial Average, and listen, in the video we talk about that there had been signs of some euphoria, a little too much excitement in the markets, and that oftentimes when that takes place, you get these sell-offs that come out of nowhere. And that is exactly what took place yesterday. It's not fun when it happens, but it is healthy for the markets, not a setback in the long term. But listen, the markets were set up for this with the run they had had over the last 6 weeks. Listen, go ahead and watch the video ahead. We got a lot of good stuff, and we'll have more for you in the coming weeks. Thanks. The stock market has been sizzling, making new all-time highs. A lot of money's come off the sidelines and into the market. Should you jump right in and throw caution to the wind? We're going to tell you today why that might not be the wisest choice. Let's get into it. Okay, so we all know the stock market has been on fire recently. It is at or near all-time highs, depending on what part of the market you're looking at. And so a question I get asked often is, hey, is now the time to get a lot more aggressive, for us to take a lot more risk in our portfolios? Well, to help us answer that, we like to look at a couple of data sets we have to make sure that there is not too much euphoria in the market. So to put up a chart of the S&P 500 to give you an idea of what the market has done, we have seen a major rally over the last 13, 14 months in the stock market, over 40%. And there have been 3 waves of the rally with 2 declines kind of breaking it up there. One this spring of about 7% and another in July and early August. 11% decline in the stock market, 17% decline in tech during that sell-off. It was pretty vicious. But since then, it has been smooth sailing for the markets with very little volatility. And here we are now in late December, and the markets are doing well. People are feeling very good about the markets in the future. So we're going to take a look, and we're going to start by looking at a survey that Bank of America does where they ask fund managers, are you overweight the equities, stocks, or not? This goes back to 2001, and you can see on the top, that means they are overweight equities in a significant way. There are circles in red. These are kind of high points at the time. If it's down below, that means they're underweight. So I'm going to focus here with November 2021, the red circle up at the top, when there were a lot of fund managers overweight. That was the peak of the bull market of 2019, and then 2020 after COVID hit. You had an amazing rally from the lows in March 2020 up through late 2021. And in late 2021, there was a mania around anything crypto, anything tech, anything EV, and there was a bubble in those areas. And you see at that time, this group got overweight equities. They went all in at precisely the wrong time. Massive market sell-off in 2022 and early 2023. And you can see at that time, this group, March 23, the red circle, they were majorly underweight equities. They thought there was going to be a recession. And by the way, that was one of the best buying points in the last 5 years for the stock market. This group was doing the wrong thing at the wrong time. Well, now if you fast track and look at now, December 2024 circled, this group is overweight equities at the highest percentage in the last 25 years. So listen, what we learned here is that at extremes, we do not want to go along with this group. They have been wrong at these key sections. So that right there is a little bit of a warning sign that they are overweight equities. Now we have another chart with them, and this is their cash levels. And you can see same kind of thing in chart 4 here. It's September 2022. Over 60% of this group was overweight cash. That again was a great buying opportunity, and this group was piling into cash at that time. Right now, this group is majorly underweight cash, the most underweight they've been in the last 25 years. So that tells you right there, hey, a little bit of caution is in order because this group is ringing a bell here. We need to take heed. Now, let's take a look at another group because that's just fund managers in the Bank of America survey. There is another organization we follow. This is the National Association of Active Investment Managers. It's a mouthful, the NAAIM. What you're going to see, this goes back the last 5 years. When this is up near the top, 90 and above, that means this group is all in on stocks. When this is low, down at 30 or below, that means this group is out of the market. They have very little stock exposure. We're not going to bore you to death, put you to sleep by going into every one of these levels here, but I will tell you that when this is above 90, you want to exercise a little bit of caution. When it's down at 30, 40, in that range, that's when it's a great buying opportunity, tends to be. So when we look at those factors, we will say that, hey, the last couple years, it was smart. There was a lot of pessimism about the markets and the economy, and we were of the belief that the stock market and the economy was going to outperform expectations, and that's exactly what happened, both in 23 and 24. Now there's been a little bit of a transition here where everybody's kind of going over to the other side of the boat where they're very optimistic, a little bit euphoric about parts of the market. And so that's when we say, hey, we don't want to chase. We don't want to take more risk than we should just because things are going really well, because a lot of times this is when you get some of the sell-offs that we've seen in the last 2 years, 7, 10, 12% sell-off. And it wouldn't surprise us at all if that happens early in 2025. Now, that being said, we also hear some people saying, hey, is this a repeat of the dot-com bubble? We know that tech stocks are on fire, Bitcoin's on fire, there are lots of parts of the market doing really well. Could this be a repeat of what we saw in 98, 99, 2000? We have a chart that looks at tech stocks from 1995 to 2000 and compares it to the run techs had over the last 5 years. And if you put that up, you will see, and on the far left, by the way, that is starting day one and going all the way on the bottom axis there. That goes to where we are today, which is what, day 1481? It's 5 years, okay? 5 years that's gone by here. And what you'll notice is that the NASDAQ went up in black, that is 95 to 2000, went up almost 700%. At one point there, if you follow that, and it then had a decline between 2000 and 2002 of 80%. And guess what? I started my career in 1998 as an intern at Merrill Lynch. This is all anyone wanted. No matter what their age was, their income, whether retired or not, they wanted to be in tech because tech was all the rage at the time. 80% decline that followed, it decimated portfolios. Tech over the last 5 years in red has done very well, but it is up about 300%. Okay? So much less than what we saw back in the dot-com era. Now, I will also say that there was a major difference back then. You had companies coming public that had not only no profits, no revenue, and their stocks were skyrocketing to the moon. That is not happening in this environment. In fact, the last couple of years, companies have had a hard time coming to market. There have not been many companies coming to an IPO. Back then, anyone and everyone who could hang a shingle and say they were connected to the internet went public and their stocks went to the moon. So there has been a much bigger difference. This time, the big tech companies that have done so well, their profits and their revenues have been exploding higher. And so that means that their valuations, they deserve the multiples they've had. They also have very high profit margins. So the fact is, This is not a repeat of the dot-com era, but it is smart to take a little bit of caution when everyone's on one side of the boat, as excited as they have been recently. All right, for our next topic, we are going to check in on small business owners. We have done this from time to time over the last couple of years. There is the NFIB, National Federation for Independent Businesses. They have been doing a survey back since the early 80s where they survey over 10,000 business owners every month, and they ask them a series of questions. The main one is, how optimistic are you right now for your business? And then they get into details if you want to see the survey. It's pretty fascinating stuff if you were a nerd like me. But I'm here to tell you what you need to know. And so what we just found, we just got the November read for small business owners, and it came in at 101.7. This was the biggest 1 month jump in the history of the survey. And it really boils down to this: with the election outcome, cut in regulations and cut in taxes are very favorable to small business owners. And so that their optimism for their business has gone up significantly. And if you can look back, you will notice that earlier this year, this number was at 88, which was the lowest it had been since 2012. And there were a number of reasons for that. One of them is higher interest rates after the Fed's rate hike cycle that they had a couple of years ago. That really hit small business owners hard because a lot of them rely on financing for growing their business, and interest rates are now in the double digits for small business owners. Well, now we have the Fed. They have begun cutting interest rates, and we're filming this on a Tuesday. The Fed will be cutting again on Wednesday. By the time you're seeing this, they will have just cut for the third time. That is very favorable for small business owners. Interest rates for them to borrow have come down. Plus, like I talked about, the thought of lower taxes and lower regulations, that is also positive. So we saw this from small business owners, by the way, back, I'll just point an arrow here, in 2016. This went significantly higher then after the election, and you can see it continued to go higher for the next year and a half, and a lot of small business owners saw profits go up significantly, especially after the tax cuts of 2017, all the regulations that were cut then, those were very favorable. We want to see in the next few years small businesses really outperform and do well, hire a lot more people, because the last few years has been dominated in the economy by big tech and cybersecurity. They've been doing fantastic, and we hope they continue to do well, but small business owners have not done as well, and small cap stocks have significantly underperformed. We have been majorly underweight small cap stocks the last few years for these reasons, and that's been the right call. But early indications are small business owners are optimistic for 2025, and that is good to know. Okay, speaking of 2025, our next two videos you don't want to miss. Our next video is going to be our 2024 recap, and then following that, our 2025 outlook. Now, I'm going to give you a little tease of our 2024 recap. At the start of the year, all the Wall Street strategists, the big banks, all gave their price target for the S&P 500, how the stock market was going to do. And we did a video on that and talked about that. It's a very hard game to play. But nonetheless, these folks are paid a lot of money to play it. We're going to put a chart up here that shows at that time the year end for 2024 price level for the S&P 500. In yellow in the middle, the average target was 4,861 for the S&P. Over on the far left, JP Morgan, who's an amazing bank. They got a great CEO, Jamie Dimon, but their strategist had a price target of 4,200, so expecting the stock market to do poorly. You go all the way across there up to Yardeni Research in the red on the far right, 5,400. He was the more optimistic. He was the most optimistic. But take a look on the far right. The S&P 500 is at 6,090 in blue. If you take a look, none of these strategists came close. And if you look at JP Morgan, Morgan Stanley, Wells Fargo, Bank of America Merrill Lynch, listen, these are all the main Wall Street firms. And guess what? They were very wrong. And if someone listened to them and invested very cautiously because of it, they have significantly underperformed this year in what has been a great year for the markets. So we're not going to hammer them too hard, but in our 2024 recap, we're going to tell you what you need to know and what it means going forward. Okay, so to recap, in today's video, we talked about how the stock market has been on a tremendous run over the last 13 months, especially the last 2, but how it is also not the wisest thing to throw caution to the wind and chase after the markets. We looked at small business owners, and the most recent Optimism has the biggest 1-month jump in its history. This is positive for 2025. We love to see small businesses thriving. We also talked about the fact we will have a 2024 recap in our next video. Be on the alert for that. Thanks for watching and take care.